Globally speaking, there's just been an influx in demand. Lately, Bitcoin is almost perfectly correlating with like the software stock indices. Like everyone's pointing out that ETF, IGV, I believe it is, and it's almost a one-to-one correlation. It could be the algorithms doing it, but really no way around it. There's just not been a lot of retail demand for Bitcoin this cycle. It's almost all been in the corporate sector, all been in the institutional sector. To the extent there is retail demand, it's mostly been in higher net worth retail that have brokerage accounts, that they have access to the ETFs now. And so right now, there's not a lot of retail buying. And there's still something like $1 trillion in crypto market cap that I think is overvalued. And I think it is kind of a gradual stagnation. And, it'll have cycles up and down. But that's kind of just an anchor, I think, around the real story, which is basically Bitcoin and stablecoins and, a small tail of other things, tokenization in general.
Bitcoin isn't crashing in isolation anymore. It's moving almost step for step with software stocks, sliding around with the iShares Expanded Tech Software Sector ETF, like it's just another tech position on a fund manager's screen. That old Bitcoin does its own thing narrative? It's fading fast, and you can feel it in the energy. There's no weekend frenzy, no explosive altcoin season sucking everyone back in. Crypto Twitter is quieter. Retail traders aren't stampeding into exchanges. Instead, it feels managed, slower, more calculated. Bots are skimming liquidity. Funds are trimming exposure. It's less chaos, more choreography. Macro analyst Lyn Alden talks about a transfer of power in markets. And honestly, this bear market makes that obvious. The people moving size now aren't scrambling with cold wallets. They're adjusting allocations through brokerage accounts and ETFs. Meanwhile, a lot of altcoins are just drifting. Little relief rallies here and there, but no real sustained momentum. What's really happening is consolidation. Capital is clustering around Bitcoin and dollar-backed stablecoins. It's not euphoric money, it's patient money. Sitting. Waiting. That's why this bear run feels different. It's quieter, more institutional, almost absorbed into the broader tech narrative. And while retail watches from the sidelines, the structure underneath keeps evolving. Let's bring you more clips from Lyn Alden's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Well, I think in recent times, the changes we're seeing with the balance sheet and rate cuts, that's not fueling inflation because it doesn't really fuel money supply growth. Even things like tariffs, they're not particularly inflationary in the broad sense because they're not impacting the money supply. They can just around the margins show up. They can obviously increase the price of one thing. They can also reduce the demand and therefore reduce the price of other things. So it just kind of shifts things around. I think right now we're in a transitional phase in macro, which is we're exiting balance sheet reduction, going toward balance sheet increases, but the numbers are not large. That this isn't, COVID printing that people think of now when they think of QE. It's more of a steady state. And then we're also in this, because we're in a period of fiscal dominance, a lot of the traditional metrics just work differently now. We have these larger average fiscal deficits, which injects capital constantly into parts of the economy. So senior spending, basically anyone who's on the receiving side of the deficit. So the Defense Department, all the contractors there, the healthcare system, Social Security spending. That's where the capital is going into the economy, and of course other parts are squeezed. So we're in this like holding pattern, and as long as energy is flowing and cheap, right? So as long as oil is not a bottleneck. That keeps a lid on inflation. And so they have quite a bit of runway, I think, to go forward with probably some rate cuts. And I don't think the balance sheet expansion will be particularly inflation in the next, call it year or 2 years. So I think inflation's a spectrum because it doesn't show up evenly, obviously. And there's a pretty simple calculation, which is you have the debasement rate, basically money supply growth, and then you have some amount of productivity growth. Right now, obviously, AI is a big factor, but over time, it's automation, it's everything, all of our technology, all of our organization. We're billions of people every day are trying to make things cheaper, essentially, and finding new ways to make things cheaper. So you have that, let's call it 7% money supply growth over the long term, and then you might have 4% productivity increases every year. So that difference, roughly speaking, that 3% in a longer term pattern is the price increases. And around the world, central banks are basically doing their best to counteract the deflation that we would get from productivity growth with that money supply increases. And so, but there are periods of time where we don't get like much more productive in a given 5-year stretch. It could be because there's energy shortages. It could be because there's war or something like that. And other times you're in that period where productivity is flowing. And then as that money supply growth happens, it doesn't show up everywhere equally because we're not 4% better at making gold this year. We're always just marginally better at making that. We're not better at making Bitcoin this year, obviously. And then, you go down the stack from there. So we're not, every year we're not way better at getting more oil out of the ground. We're a little better. We're not way better at making houses. We're a little better, but we are exponentially better, for example, making software. We're exponentially better over the several decades of making electronics. So when that happens, when you have that kind of longer term money supply growth, it shows up in the assets that we're not getting better at making. Same thing with like the best stocks in the world. We're not getting better at making NVIDIA stock, for example. And that's where all that debasement capital shows up. And then the long tail of things that we're way more abundant in, they get cheaper and then they weigh down the CPI basket. And that's what allows the central bank to be pretty dovish. Well, the cool thing about assets is you can own both. I think there's been an unnecessary animosity between Bitcoin proponents and gold proponents. I mean, there are plenty of us on the macro side that own both. I think a lot of things, it's always surprising how things can happen all at once. So I've been in the gold bull camp, but for example, if you would have asked me a year ago, would we have seen $5,000 gold by now? I would have said wouldn't be my base case. And of course, once gold runs, you get runs in silver and platinum with a lag. I mean, I think most of the narratives we see around it are at least directionally true, which is that we are seeing countries diversify, in percentage terms away from treasuries and toward gold. No major sellings going on, but there's like the marginal interest is more in stacking tons of gold. And then you get momentum building from there. And so if you look in history, kind of the US stock market had kind of 4 main bear markets against gold, right? So when we price things in dollars, it's always tricky because dollars themselves, that we just discussed, are debasing. When you price S&P 500 in shares of gold, I mean, in ounces of gold, we've had kind of 4 major bear markets over the past, call it a little over a century. I think right now we're in the 4th ones going on, right? So equities, although there's many good ones, they've been debased pretty heavily against the money supply. And globally speaking, there's just been an influx in demand. Lately, Bitcoin is almost perfectly correlating with like the software stock indices. Like everyone's pointing out that ETF, IGV, I believe it is, and it's almost a 1-to-1 correlation. It could be the algorithms doing it, but really no way around it. There's just not been a lot of retail demand for Bitcoin this cycle. It's almost all been in the corporate sector, all been in the institutional sector. To the extent there is retail demand, it's mostly been in higher net worth retail that have brokerage accounts, that they have access to the ETFs now. And so right now there's not a lot of retail buying. The interesting thing is that as euphoric as precious metals got, the retail only really came at the tail end of it. So when Bitcoin was when gold was in a kind of a shadow bull market, maybe 18 months ago, there really wasn't much retail participation. They only came in on the tail end. And I think Bitcoin just this cycle pretty much lacked retail. I think part of it is the shiny object syndrome, partially for good reason. I mean, AI has obviously captured a lot of mind share. I think that's a big factor. And I think broadly speaking, the kind of the lack of the crypto cycle this time probably weighed on it. I'm on record not being, I'm pretty bearish on the broader crypto space structurally, but they tend to have a lot of capital. And so they kind of fuel some of these cycles. And they didn't really have a season at all this particular cycle. And I think if anything, they are weighing on kind of the quote unquote brand of Bitcoin. When people, when media and in general, when people talk about Bitcoin, they lump Bitcoin with crypto. So they think of meme coins, scams, the broad array of issues. They think of losing money when they think of that. And I think that's going to weigh it down probably for a period of time. There's still something like $1 trillion in crypto market cap that I think is overvalued. And I think it is kind of a gradual stagnation. It'll have cycles up and down. But that's kind of just an anchor, I think, around the real story, which is basically Bitcoin and stablecoins and, a small tail of other things, tokenization in general.
In this bear run, the liquidity story isn't dramatic. It's slow. Balance sheet runoff is winding down, sure, but what replaces it isn't a flood, it's a drip. Deficits keep pushing money into defense, healthcare, pensions, steady streams, not stimulus tsunamis. And because supply growth is tight and productivity keeps improving, inflation hasn't reignited. Energy stays relatively cheap. The pressure never fully explodes. Think of prices as a tug-of-war between currency debasement and productivity. Automation and AI are cutting costs faster than policymakers can inflate them. That's why gold holds its shine. Bitcoin moves cautiously alongside tech benchmarks, like the iShares Expanded Tech Software Sector ETF, and speculative altcoins continue to sag under their own excess. In this environment, hard money and stablecoins quietly gain ground. Digital dollars dominate daily transactions. Bitcoin, volatile as ever, sits more like long-term collateral than casino chips. AI is compressing white-collar wages the way globalization once squeezed factory lines. Politicians paper over the adjustment with deficit spending, each sector lobbying for its share. But here's the tension beneath this quiet bear market. If productivity keeps suppressing inflation while liquidity keeps dripping in, what finally forces the next real breakout? Let's take you back to Lyn Alden as she discusses more on this.
Basically, stablecoins, they attach the existing network effect of the dollar, and to way lesser extent other fiat currencies. They're almost all dollar stablecoins. And when people are using money for shorter term like working capital, volatility is something they want to avoid. And so I think basically as long as people have liabilities denominated in dollars, so whether it's debts or whether it's things that other things they owe in the future, whether their paychecks are denominated in dollars or other fiat currencies, there's going to be interest in stablecoins. I think that market cap is going to keep getting higher, call it for the next 5 years, and we'll see how that goes. And also, every Bitcoin transaction is taxable, right? So I think it would go a long way to have kind of a de minimis exemption on Bitcoin capital gains to make it more flow as money. And then in addition, one of the downsides of stablecoins, of course, is that they can be frozen when they are centralized. But the vast majority of people, especially for their working capital, they don't lose sleep over that. So I do think that stablecoins are going to continue to be around for a long time. And I do think that they somewhat pressure kind of the Bitcoin narrative. But I think at the end of the day, Bitcoin has that decentralization aspect. It has that long-term capital aspect. And I think not until Bitcoin is much larger and less volatile would it really kind of catch on as something that people regularly pay with. But when you look at like say River Finance, like when they do analysis on Lightning Network and volumes, the volumes are actually pretty decent on Lightning, for example. There is volume happening. There are billions of dollars of transactions happening, just not the trillions that many people would have maybe hoped for. Well, I think it is I think the biggest factor is it is a productive force. So over the, call it 5-10 year period, as we discussed earlier, it does weigh down on aggregate inflation. Even if other things go up, for example, if the cost of power goes up, or eventually we have another oil bull market and that gives us some inflationary pressure, it is a deflationary force on white collar work. If you look over the past 25 years, most of the reduction in inflation we've seen is mostly in manufacturing, electronics, textiles, things like that. And that's where the combination of offshoring and automation has weighed down basically, blue collar deflation in a sense. And what this does is it kind of puts that same sort of force we've seen over the past 25 years into white collar labor. So things, accounting can be way more efficient, and translation can be way more efficient, and editing can be way more efficient. And it kind of goes up the stack from there. And that's, in the US, it's obviously tens of millions of jobs that are impacted. I tend to be an optimist in the sense that obviously it's disruptive when it happens, but I think that people adapt. And I think that, productivity is a good thing. When they invented the tractor, it's not like, it was a apocalypse of farming jobs. It's just that every farmer got way more efficient at farming. And then some of them, obviously, as generations went by, could go into other fields. So instead of having 6% of the population work in farming to feed everyone, 1 or 2% of people can work in farming and feed everyone. And I think we have a similar thing kind of ahead of us for white collar work, which is the whole back end of a business can just be way lighter because you have a smaller number of people overseeing the bots do a lot of it, which frees up them to work on other things, and that they have more abundance. Obviously, the big risk factors are in the concentration of gains that come, how societies deal with this. So I do think that we are in a period of heightened, polarization that we're going to be for the foreseeable future. But I think ultimately productivity gains are a good thing. I think people tend to like money printing when the printing goes toward them, right? So for example, during the whole stimulus and the aftermath of the lockdowns and stuff, industries are trying to make sure that they're getting, bailed out. And so I think that it's one of those tragedy of the commons situations where, everybody suffers from the debasement, but not everyone suffers from it equally. If you're in finance, it's like people here, you can short the fiat currency and be long assets, and you can actually benefit from debasement. Whereas people who, they work every day, their salaries are denominated in dollars. That's a friction that they have to go through every time they're trying to get a raise, every time they're saving. But I do think that, going forward, the reason the deficits exist is because people want them, and they're all fighting over the pie to make sure that they're getting it. Right now, it's going toward healthcare. It's going toward the aging demographics. The top-heavy Social Security system we have. It's going toward defense. To the extent that we do get job losses from AI, if we get a more pessimistic scenario where we do get kind of pretty weak labor market, I think that you'd see more people clamoring for answers from their politicians. And if it hits a critical mass, then that's an avenue of money printing, and that's a whole nother part of the deficit that I think we'll see. One of the tricky things is that the GDP growth we're seeing is very concentrated, and the deficits are they feed into the GDP calculation as well. So basically, anything that's kind of focused on AI or on the receiving side of deficits is generally booming. Whereas the long tail of other things is the classic K-shaped recovery that it's called, or two-speed economy. That's very real. The short answer is, long as energy is flowing and there's no bottlenecks, that does a lot to keep inflation down. Almost any kind of major inflationary cycle in history usually has high oil prices associated with it. So anything that either the administration or globally can be done to make sure that oil is not the bottleneck and natural gas is not the bottleneck and power is flowing in general, and pro-nuclear type policies, whatever the case may be, depending on the country, that's the place you can get to where you have pretty high growth with inflation that's at least under control. And so really, when analyzing if inflation's going to come back or not at scale, I think you start with the oil market and go from there.
Wall Street's love affair with Bitcoin was billed as a marriage of convenience. Institutions get scarcity. The asset inherits blue-chip stability. The honeymoon is ending. Since October 10th, nearly $8.5 billion has bled from U.S. spot ETF vaults. CME futures open interest is a third of last year's peak, and Coinbase quotes trade at a stubborn discount to Binance. Money is tiptoeing to the exit, leaving charts gasping while stocks and bullion find buyers. Lyn Alden warned that Bitcoin's latest cycle was fueled more by corporate treasuries and quant desks than by grassroots fervor. With retail mesmerized by AI shares and stablecoins soaking up working capital, a Wall Street shakeout bites. Hot money leaves faster than it arrived, exposing leverage built behind ticker symbols. Institutions chase basis trades and liquidity spreads, not ideology. When Treasury yields climb and tech outperforms, Bitcoin is the first position to trim. Yet the macro backdrop she outlined has not vanished. Dollar deficits still gush, AI keeps leveling production costs, and scarce assets remain prime receivers of monetary debasement. Today's slide looks less like a repudiation and more like a reminder that adoption paths are jagged. Gold endured decades of doubt before re-rating. Bitcoin may likewise migrate beyond New York order books into a broader global ledger. If this retreat lasts, the network will adjust. Miners will relocate, stablecoin rails will deepen, and energy-rich buyers can replace fading ETF flows. Volatility is still, for the moment, simply the tuition fee for discovering a neutral reserve asset. As we wrap up, after hearing Lyn's thesis, are you more inclined to add gold, Bitcoin, or sit in cash right now? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.